Well, thank you very much indeed. And look, I suppose I'd sort of just start by sort of brief preamble that I'm going to be looking here at the sort of longer term trends that we see for sort of copper, and I'd sort of echo the comments that really this is the material without which the decarbonisation, the electrification of the global economy simply doesn't take place. Its ubiquity across all industrial processes and the size and the importance of the market really make it the most, I think, important commodity in the upcoming energy transition. But more than that, it's also the reuse of copper in the broader industrial processes, quite apart from its role in sort of decarbonisation, that makes this such an important commodity. And indeed, if you take a very long-term perspective, you can see essentially the political history of the world writ large in the copper consumption statistics. And of course, one of the surprising things I think that catches people, or one of the comments that people often make is, of course, the dominance of China as the sort of industrial sort of hegemon of our era. But of course, it wasn't always thus. I mean, the UK at its height consumed over half of the world's copper output. At its height, it also consumed about 75% of the world's output of iron ore. Of course, the UK was taken over or superseded by the United States. And of course, the United States in turn was superseded by China. And of course, with that industrial position, with that hegemonic position as the industrial leader, also, of course, comes the position in terms of sort of global trade. But of course, with that sort of global trade also comes the ability essentially to set the rules of the game in terms of the global mining industry. And for a company like Anglo American, where we are looking to invest across the globe, wherever the sort of resources are, that comes with it, with that comes a whole host of additional sort of challenges. In any event, what I'm going to sort of try and do in this sort of presentation is just give a brief sort of overview of some of the demand and some of the supply side issues facing the industry, with a view, of course, to then sort of trying to get a calibration on what that implies for the future direction of what we need to solve for if this decarbonisation initiative, if this transition to a low carbon economy really has any hope of succeeding. And the first point to sort of make is really that quite apart from sort of electrification, quite apart from electric vehicles and so on and so forth, there's the use of copper as an industrial metal. Now, if you were to take the opening line of Das Kapital, it sort of starts off with this sort of slogan that the wealth of the societies in which a capitalist mode of production prevails presents itself as an enormous accumulation of commodities. And nowhere can you see that writ better than in the copper numbers. So here is essentially an analysis of the global economy from 1900 to date, charting the rise of the installed sort of stock of copper. And that, of course, represents, therefore, the global fleet of vehicles, the global stock of housing, the stock of manufacturing goods, manufacturing capacity, and so on and so forth. And at the same time, what you can see here on the other side is essentially the development gap between the rich countries, the 15% of the world's population that have consumed 80 to 90% of the output of pretty much all raw materials to date, and the developing world on the left-hand side of it. So essentially 85% of the population, of the global population, sit at a stage of development that is an order of magnitude below what we see in terms of the installed stock of metal in the global economy. And of course, if we are going to enable a sort of green transition to take place, I think our sort of view is that it also has to be a just transition. You can't simply expect a sort of decarbonisation of the global economy to take place, but at the same time you don't bring economic development in lockstep. And of course that then sort of highlights the sort of magnitude of the challenge on the demand side facing the industry. So if we know what the sort of total embedded stock of copper is in the global economy today, we know where that stock of copper has to trend in the future, then of course you can do some pretty simple maths and work out what then is the requirement of the global mining industry to supply that delta. And the basic point here is there's been about 500 million tons of copper, net of recycling losses, that have been pulled out of the ground over the course of human history to date, embedded in the global economy, and it's that 500 million tons of copper, an equivalent amount of steel and so on and so forth, that really stands behind the levels of output that we sort of see, the $100 trillion of global GDP that we see today. Now, of course, if we are going to then sort of deliver or close that development gap, then that 500 million tons of copper needs to grow to about 2 to 2.5 billion tons of copper. That's about 2 times the known reserve base of the entire sort of copper industry. Now, that's not to sort of present a sort of neo-Malthusian sort of, i.e. we are going to sort of be unable to deliver it, but it does make the sort of point that for all practical intents and purposes, demand for copper is essentially unlimited. And at the same time, if you were to break down the demand for copper decade by decade and then use that as a sort of guide for where the future for this material, for what we need to deliver, and how we've been able to, or rather where that demand has come from, again, that's sort of quite sort of illustrative. So what this is essentially a simple sort of Kaya analysis of demand for copper over the last sort of, well, to year dot, right? What it shows, of course, is that the contribution to that from population growth, there are more people engaged in greater forms of economic activity. But the critical point here is that the metal intensity of that economic activity has risen over time. It hasn't fallen, right? So despite thrifting, despite substitution and so on and so forth, the global economy is more copper intensive today than at any point in the past. And of course, all decarbonization is, all electrification represents, is an increase in the aggregate metal intensity of the global economy. So we can fully expect that to continue to rise. But at the same time, recycling, the primary to secondary share of this metal, has basically been flat, right? So there has been no movement in essential recycling as a contribution to the supply of this metal over time. So, all in practical purposes, demand for copper is unlimited. The real issue is, of course, on the supply side. How are we going to meet that demand? This just shows essentially some of the challenges that we're sort of facing as the global mining industry, and it shows the expectation versus outturn for supply over the last sort of, if we sort of take a sort of decade step back. The number of projects that we thought were going to be commissioned versus the reality of what was actually delivered. As you can see, delivering primary supply of this metal is an exceptionally difficult proposition. And why is that? Well, there are a number of reasons. The first of which is the cost of capital to the industry is punitive. It's very, very hard to raise money to develop mining projects. Now, this, of course, applies more broadly. It's not just a question of the copper. It's a question of, and I think everybody who's involved in the mining industry sort of knows this. If you look at the relative valuation of the mining industry versus the broader market, the point is that the mining industry has decoupled from the broader cost of capital of the Western economy, at least. It's an increasingly difficult proposition to be able to raise capital to invest that in the future supply of mines. And of course, given the capital intensity of the mining industry, that cost of capital is of course an ever greater impost on the industry. At the same time, the discovery rate of the mining industry, of the copper industry in particular, has slowed markedly. We are drilling more than ever before. We're investing more in exploration, and the result of that is increasingly stretched. It's getting harder and harder to find new deposits. So even if you could find a deposit, actually funding that is an incredible challenge. At the same time, productivity in the mining industry has stagnated over the last few decades. So again, right, all of the sort of low-hanging fruit of easy sort of technological gains in the mining industry appear, at least for now, to have been exhausted. So in the face of that, then what we have is geological deterioration in the existing sources of supply. We all know this point, sort of grades in the copper industry are falling, mines are getting deeper, stripping ratios are going up, ore bodies are becoming more and more geologically complex. But in order to offset that, we haven't seen the shift in productivity that hitherto enabled the industry to overcome that the effects of that geological deterioration. Overlay that, of course, on the cost of new supply arising from the environmental and the ESG burden that's incident on the industry. And again, what we see is yet another factor that makes the supply of this material ever more incrementally harder to deliver. And then we come to the sort of final point, which is the geopolitical environment, the backdrop on which we operate, is becoming more and more complex. If you look at the map of global trade in 2000, what you saw was the world dominated by the United States of America. And of course, that was prior, of course, to the rise of China, when the US industrial position, it was the largest manufacturing country, it was the largest exporting country, and of course, that has been overtaken significantly by China. There are very, very few countries now where, when you sort of color the map blue versus red, that you can see the position of the West. So, of course, that means to say that the rules of the game in terms of accessing deposits, what it is to be able to develop, to get your hands on new sources of supply, is also becoming increasingly difficult. So all of that sort of paints a picture for this metal where demand, the most important metal in terms of the electrification and the decarbonization of the global economy, is set to increase, and I would agree with the sort of benchmark projections roughly in terms of the direction of sort of near-term travel. But it's really on the supply side of the industry that our attention is focused. What does it actually take? What will it take to deliver the next wave of future supply? And of course, the point here is that price is going to have to solve this problem. If nothing else will, it has to be price. And here you can see the history of the long-term broker consensus for commodity, for copper price versus the spot price of copper itself. The point here I would sort of flag is that the consensus view around price formation is entirely a lagging indicator rather than a leading indicator. All consensus price expectations actually do for any commodity is tell you roughly what the price of that commodity was last year. The prognosticative power of consensus is precisely zero. But what we can do is observe a few things. So if we look back at the history of consensus and why that consensus forecast has been wrong, the answer really comes down to the supply side of the industry. In the early 2000s, the view of the broader market was that the productivity gains that we had seen over the course of the 1980s and 1990s would be sufficient to offset the effects of the geological deterioration that was becoming increasingly apparent in the world's supply base. That, however, proved to be false. Those productivity gains ground to a halt, right? As a consequence of that, the full force of the inflationary pressures of geological deterioration were seen. It was for that reason, essentially, that the consensus view of $2 copper in perpetuity, that was the sort of view of the early 2000s, was unwound. So, of course, then the question is, well, what will it take in the future? And, of course, the view here is that the price of copper needs to rise significantly to both deliver the incentive and the means for the mining industry to produce the supply that is required. So that's the, With that, I'll just say thank you very much indeed.
A great presentation. Hopefully everyone in the room is now as familiar as yourself or me in terms of the importance of copper, for sure. Like I said, very passionate about it. I'm actually a wire and cable guy.
Right.
Yeah, exactly. So I understand its applications and uses and just how important it will be for the energy transition. You mentioned obviously the demand picture looking very robust and strong, but the focus being on the supply challenges. You mentioned quite a few challenges: declining head grades, cost of capital, etc. Is there one that's more challenging than the other? What would the focus be when we look at the supply side, answering the question, how do we plug that deficit, that gap that we're projecting?
Look, I think there are a number of things that have to take place. I mean, the first of which I think is the legislative environment has to change from one that is essentially adversarial to one that is supportive, right? I mean, if we look at some of the changes in the sort of regulatory environment that has taken place, let's say from the 1980s to date, over a broad sort of span, it used to be the case that the regulatory agencies were trying to support the development of resources, and of course, but support in compliance with the standards that that we require. I think that has changed, or that changed in over time to become something that was essentially sort of almost combative, almost adversarial, looking to find reasons why the mining project couldn't go ahead, right? As opposed to how can we jointly bring this together to create the sort of value maximizing sort of proposition. So I think that legislative environment has to change. It has to be made faster. It has to be made easier. I think the cost of capital is a clear sort of point, right? The mining industry has to be valued in proportion to the value of the goods that it produces. At the moment, it simply isn't. The incentive for most mining companies, or at least most incumbent producers, right, is to buy back their own stock. The cost of capital, what it's doing is, of course, is making existing production cheap, right? Future production prohibitively expensive. What does that do? What that means is to say is that the only thing that you're really looking for is to buy or increase the per share exposure to existing supplies. That's either buying other people's assets, and Anglo, we're in the middle of, we've been approached on that front, or it's buying your own assets. So it's share buybacks, it's buying other people's production, but it's not investing in future supply. Those, I think, are the two greatest sort of single imposts that need to be overcome.
Thanks, Paul. And just time for one last quick question. And again, it's coming back to this supply gap. And if we can answer some of these questions and we can sort of begin to solve the problem on the supply side, are we going to meet it? Are we going to meet enough material to satisfy the demand, or are we actually going to see some demand destruction in a way where we are forced down a route of increased substitution or more thrifting than perhaps was previously projected?
Yeah, look, I think it's a great question. I mean, I think fundamentally price does sort of clear the market, right? It's just a question of what. I mean, we will never end up with a sort of structural deficit actually of any metal because by definition, negative tons don't really exist, right? What we will actually have is a price that will move to create new supply or destroy demand. I mean, I hope it's create more supply. If you destroy more demand and you sort of end up substituting into materials that are essentially inferior for the task in hand, that doesn't actually I think over the longer term really sort of help the help the issue. But I think we will see increased thrifting, right? I think that dynamic will continue. Of course, we will see again increased substitution. Aluminium is the sort of obvious sort of metal into which we will substitute. But if you look at the own price elasticity of copper, i.e. thrifting, and the cross price elasticity of copper, i.e. substitution, you can get a sort of sense of how easy that task is. And there just isn't that much metal that is shed as a consequence of that. Principally because this industry is an old industry, right? An awful lot of the low-hanging fruit by way of substitution, by way of areas where you can sort of move away from the metal, that's already taken place, and it took place principally during those periods where you've seen price spikes, historically. So the low-hanging fruit is a lot less in a mature industry like copper than it is in some of the more nascent sort of metals and more nascent markets.
Thank you very much, Paul. I think we'll leave it there. I know there's probably some hungry folks in the room. So I would like to mention, before I thank Paul one last time, that we'll be having lunch now on the marina. We're going to reconvene across both stages at 2 p.m. and we'll catch you there. But please join me in thanking Paul for his talk today. Thank you.